Good afternoon, everyone. Today we're going to talk about, welcome to week 10. This week we're going to discuss about leasing and introduction to options. Okay, let's start from here. And the questions we're going to cover today is this. What are the differences between operating and financial lease? We're going to talk about how can we determine the merits of leasing as opposed to purchasing an asset. We'll do an example on this one. And we will talk about what are the basic features of call and put options. And we'll talk about how do we calculate the fundamental or intrinsic value of an option. This will be our topic to discuss today. Let's start with what is leasing. Okay. So the first you can see here that we have the definition of lease has been provided in here. So two parties involved in here, leasing and the lessor. All right. So here we see that a lease is a contract under which one party, the leasing, agrees to make rental payments. So for example, okay, let me finish it off, then I will explain. Agrees to make rental payments, lease payments to the owner of an asset, the lessor, in recompensate for using the asset for a specific period. So what they're saying here that you are taking a lease of an asset. We're taking a lease of an asset. And since you are taking the lease of the asset, you're going to use the item and you will be actually paying for using it as a rent. Let me give you another example in this. For example, let's say that you need a forklift, for example. For some reasons, you need a forklift, okay? And since you do not have enough money to buy the forklift, it's not about enough money. Sometimes it's about maybe you have some other reasons. Maybe you have some other economic benefit for leasing. That's what we're gonna see, whether it's a good idea to purchase or it's a good idea to lease. Not necessarily all the time, just because you have money problem, that's why you're leasing. Not necessarily, okay? It depends on the economic value. Okay, so we see that, let's say you need a forklift, and now what you're doing, you are going to actually lease it, which means you are not buying it. Don't think that you don't have money, that's why you're not buying it. For some reasons, you're not buying it. What you're doing, you talked to a forklift company and told them, I'm gonna use this forklift for next 6 months, for example. And I will pay you a monthly rent in it. Okay, that's the thing is rental payment. That is your lease payment. So you are the person who is taking the forklift for using. And you will be called lessee, this one, lessee. The forklift company who is allowing you to use their forklift for a payment, that party will be known as lessor. And you're doing it for how long? For 6 months. That's a specific time. This is a leasing agreement. Okay. And this says here, so in this case, the lessee borrows the asset, not the money to buy the asset. Lease payments are tax deductible by the lessee provided the asset is used to generate taxable income. And the lease payments do not represent an arrangement to purchase the asset by an installment. Not buying it for an installment. How about lease agreement in Australia generally specify an option whether you want to buy it or not. Specify an option to buy the asset at its residual value at the end of lease period. So after using the item for 6 months or 6 years, whatever that time period is, then they're going to make a valuation of that forklift. And they will see what is the value of this asset. And if they see that, okay, this is the value of the asset, and they can actually offer you to buy it at the residual value. If you want to buy it, you buy it. If you don't, that's okay. They will take the asset away. That's fine. Okay. Now, another thing is depreciation is another issue comes here. So they say the lessee cannot claim the depreciation of the asset for tax purposes. The lessee cannot say that my machine is depreciated. No, you cannot do that because you don't own that asset. Who can claim it? Lessor can claim it. Okay. Now there are two different types of lease we have: operating lease and financial lease. Look, learn that there are two types of lease. Okay, but according to Australian Accounting Standard Board, not Australian Accounting, international law, it says these things, that there will be no more of the one type of leasing will be the financial lease. Okay, I will show you how it is quite the same. All right, an operating lease is characterized by a lease term that is generally less than the economic life of the asset, and total lease payments that are less than the initial cost of the asset. Operating lease is that, let's say, the forklift you are using or a crane you are using, this is an asset. It has a lifetime of, let's say, 10 years. Operating lease will be when it will be that you will be using it for, let's say, 8 years, less than the lifetime of the asset. Okay. And total lease payment will be how much? Less than the cost of the machine or the asset. And operating lease can be cancelled. Okay. An operating lease is cancelable by the leasing before the term of the lease expires. And you can cancel the operating lease. Okay. And it needs to be disclosed in financial statement. They will have to be disclosed in this. Next one is about finance lease. What is financial lease? It's characterized as covering most of the economic life of the asset. Most of the economic life will be covering, like out of 10 years. My example, I said 8 years of 10 years. No, it's actually, let's say 9.5 years. Most of the time it's gone. So operating lease might be less than that. Maybe 8 years. Yeah, 8 years also almost all. Yeah, almost there. 8 years almost there. But let's say operating lease will be maybe 6 years. Finance lease will be actually almost all of the economic life of the asset, and it's normally non-cancelable. You cannot cancel it. Non-cancelable, and if you cancel, it will be there with severe penalties. The total lease payments are normally greater than the initial cost of the asset. The difference of these two. So here, I think they'll tell you here, under the current accounting standard, finance lease give rise to assets and liability entry in a firm's balance sheet. The asset value recorded in the fair value. Okay, let me show recording. You. What did I say that leasing thing has been changed? Leasing standards has been changed. Lease standard changes by who said that? IASB. His name is Hans. What is his name? That person. Here it is. Debriefing the list is there. Let's listen to this video. You'll understand.
We have just issued a new lease standard, IFRS 16, which replaces a very old lease standard, IAS 17. We really feel there is a need for a new standard because the old standard does not truly reflect economic reality. Companies have a lot of leases outstanding, more than $3 trillion. And only a limited amount of these leases show up on the balance sheet. All the rest, the so-called operating leases, are not shown on the balance sheet. And at the same time, they really represent a real liability. And therefore, we think the fact that such a big chunk of liabilities is not on the balance sheet does not truly reflect the economic reality. Well, many investors, but not all investors, many investors, the educated investor has been making their own adjustments, multiplying yearly lease payments, for example, by 7 or 8 times. These are very rough estimates. Often they end up overestimating the lease liabilities. And then there are a lot of investors out there who do not adjust the numbers, and they are sort of misled by the current numbers. The big change of the new standard is that in principle, all leases go on the balance sheet, both operating and finance leases. The only exceptions that we make are for short-term leases shorter than 1 year, and what we call small ticket items, very small leases, for example, for office or, furniture or for iPads. And that means that the investor will from now on get a good view of all the lease liabilities and not just the finance leases, such as is currently the case. Well, I think there are two big benefits to the markets and to investors. First of all, there is a better transparency. There is more insight in the liabilities caused by leases. For example, during the financial crisis, quite a few retail companies went bankrupt. Their balance sheets were very clean. They had few debts on their balance sheets. At the same time, they had huge leasing liabilities which were not visible. In the future, these will be visible. So that's one. Second, there will be much better comparability between companies. For example, there are now airline companies that own most of their aircraft and finance it with loans. And on the other hand, there are airliners that lease most of their fleet. In practice, they might have similar financing obligations, but in current practice, the company that owns the airplanes has a lot of debt on its balance sheet, whereas the airline that leases most of its aircraft has a clean balance sheet. And that is not a good comparison, and the new standard will create more comparability between these companies. Roughly half of companies around the world do have leases, so a lot of companies will be affected, but especially will be affected companies that have a concentrated use of leases, such as the retail industry, airlines, and shipping. Those are sectors that have heavy concentration of leases, and they will be most affected. We do not expect this standard to just be met by enthusiasm. I think investors will largely be enthusiastic, but companies might think that there will be quite a few costs involved. Well, we have tried to keep those costs as limited as possible. And at the same time, I think the standard will also provide management with better insight in the true extent of their lease liabilities. And I'm sure that a lot of managers are not completely aware in detail about these liabilities. And it might lead to better decisions between leasing on the one hand and buying and financing of equipment or whatever you might lease on the other hand. And it might lead to better capital allocation, better management decisions. We have seen before that when we changed the pension standard, that it led to new awareness of companies of the true extent of this liability. And I think the same will occur with leases. At the same time, I am absolutely convinced that the standard will not put the leasing business, the leasing companies out of business, because leasing will remain a very attractive instrument for many companies. It is a very flexible way of financing your assets. And on the other hand, it's also a good way to sort of own assets without having all the full risks of ownership. So I think that leases will remain an interesting business proposition, and we will certainly not put the leasing industry out of business. The effective date of the new standard will be the 1st of January 2019, so that should give companies ample time to prepare for the new standard. I think most questions around this new standard will be about the weighing between costs on the one hand and the benefits on the other hand. That's the reason why we have performed a very detailed effect analysis, which will be published together with the standard. In this analysis, people can see what are the costs of the new standard and what are the benefits of the new standard. And I think when you read that effect analysis, that the conclusion can only be that the benefits outweigh the costs.
This is from IFRS. All right, so that I wanted to show you that this is from 2019. But this standard has been changed anyway. Okay. So now, analyzing lease, the basic question facing a firm that has decided it needs the service, a particular asset is whether it should lease or buy. That's the big question. And business will think it from the economic perspective. Okay, they will think from that perspective whether they need to buy it or they want to actually lease it. This is the decision to lease or not can be thought of a capital budgeting decision where the net present value techniques can be applied. When I apply net present value technique in here, in effect, we can analyze the incremental cash flows to do the leasing. So we see the cash, how much cash is going out and how much cash is coming in. Based on these things, we're going to actually talk about it. Okay, so simply compare the present value of the after-tax cash flows associated with the leasing and purchasing of by borrowing the capital required by the payment. So you need to purchase an asset, so you see that how much it will cost you if you purchase it after borrowing it. So you will have to include interest expense and other expenses included in here. So these things we're going to cover in here. Okay. And second one is, or directly calculate the net present value of the project leasing, referring to the usual relevant after tax increase. And let's I think we can actually do some work on it. Okay, and we'll see how it works. Okay. So here is I think, okay. But in calculating the cash flows, we either include the cost of exercising a purchase, okay, we say that the cost of exercising a purchase option in the lease cash flows, alternatively include the cash flows associated with the sale of the assets. Okay, now I think I'll take you guys straight to the point. Okay. So the following demonstration should not be given in class. Okay. So actually, I was supposed to take the example too. Yesterday, so this thing is for us, nothing to do with you guys. So this is an example we had here. Let me take this example to page. Easier to see side by side. Okay, example. Suppose a situation in which a private university is considering whether to buy or lease a car before use by its vice chancellor. Okay. Suppose they're considering they're going to buy a car, but the vice chancellor to use or not. The appropriate car cost $81,000 to purchase. Alternatively, a finance lease can be arranged involving 5 lease payments, with payments made at the beginning of each 12-month period. Of how much? $20,000. So 5 lease payments, 12-month period lease. Like each lease will be 12 months, so each period will be 12 months, so 5 years. Then, yeah, $20,000 for each. The car can be depreciated using straight line depreciation for over 6 years. So 6 years means that the economic life of the car will be 6 years. Assuming that under the lease agreement, the university would purchase the car at its book value. After 5 years, they will see how much is the book value of the car or the residual value of the car. Okay, then they're going to buy the book value, which would be equal to the residual value at the end of 5 years. University pays an effective tax at 30%, and it will be able to borrow to purchase the car at before tax interest 8% per annum. So the tax payment is 30%. Effective tax rate is 30%. It will be able to borrow to purchase the car at before tax interest rate 8%. To borrow this, so before tax 8%. Maintenance cost on the car are $3,000 per year. The maintenance cost will be $3,000. paid by the owner. Should the car be leased or purchased? Okay. That's the question we have here. So how are we going to do these things? What we are doing here is this. Look at here. All right. So this is loan amortization distance. So this much will be our one approach. This is approach 2. All right. So first approach, let's have a look at the first approach. What you're saying here, using approach 1 as in text, calculating after tax cash flows associated with the leasing. With the leasing, this is our situation concept. Lease payments will be 1, 2, 3, 4, 5 lease payments, $20,000. You're paying. Tax shield is $6,000. What is that? So tax shield, they mean here that when you will making the payment at 30% rate, you can claim $6,000 tax deductible. We said at the beginning, lease payment is tax deductible. Okay. Lease termination payment at the end of after 5 years, the book value is $13,500. So after tax cash outflow will be how much? You can see it. This is our case. Okay. So 20,000, 14, 14, 14. This is our tax. Because of tax, we deducting this money. And last year, $13,500 will be left after deduction of the tax. Now, you can ask me a question that why last year 6,000? Look, the payment you make at the beginning of the year, you can claim that tax deductible money. You can claim after 1 year. That's why 6,000 is coming. Like you make the payment at 0 year, it means starting of the year, reclaiming this $6,000 next year. That's why 6,000 coming later. Don't get confused here. Okay, so yearly and now depreciation is $13,500 depreciation. Book value of asset 5 years, after 5 years later, what's the book value? Book value again $13,500 left. Okay. All right. Tax shield, I'll mention that. Note that the tax saving shield due to the tax deductibility of the lease payment is not received until the end. I will mention that too. You will not receive the tax benefit until you finish the year. Okay. So after tax cost of debt, I will show this things in previous class that how much effective tax rate is 8% tax rate. So after tax, it will be actually 5.6%. Okay. So now, present value of cash outflow associated with the lease. Okay, what is the present value? How much money will be going out? So present value of all this money. How much? So you can see here. First year is 20,000. 1, 2, 3, 4 years is here 14,000. So you see the first year is 20. Other 1, 2, 3, 4. 4 years of $14,000. So $14,000 you see here. You can see here at the top, this is 4. This is 4th year. Okay. Last year is 7,500 is here. So you can see what they did here actually. You understand these things, right? So this is actually, I will show you, this is the 1 plus 0.056. Make sense now? How did it work? That's the case they did. Okay. That's the case. So don't get confused with these things. Yeah, that's the case, nothing else. Okay, 1 plus IR. So this T will be how much? 4. Okay, and we will be paid 5 years, 50 years. All right, so this is how they calculated and they found that the value is this much. So all the present value of all the money going out in here, it looks like this, like 1, 2, 3, 4, 56 plus 20 is 76. 76 plus this looks like $83,500. But actually, if you do the present value analysis, you find that after depreciation, those everything, you actually the present value of this amount going is 74,670.5. Okay. Now, this is about if you go for leasing. All right. If you go for leasing, this is the case you will have. Now we're gonna check. What about if you purchase? So if you purchase now, yearly loan repayment, Okay. Yearly loan repayment will be how much? We'll check it out here now. Okay. So we said we know that present value amount will be payment into 1 month. You see, if they do these things, why did they do this one? They bring the annuity tables here. Annuity. Okay. So this payment will be this. This is the formula we have in here. So how much will be our payment? So we know that our present value, $81,000 is our present value amount, and our recovery rate of interest is 8%. Our payment will be 20,286.97 our payment per year. Okay. Now we're doing loan amortization table. What is loan amortization table? Do any of you know what is loan amortization mean? Anybody? Anybody want to share something with me? What is loan amortization mean? Anyone? No? That's all right. Loan amortization means that it's a table. It's a process or a schedule, it's a schedule that tells you that at equal payment, at what amount, okay, how many equal payment you have to make, okay, to pay off your interest in capital both. And in this amortization table, it will cover your interest plus capital both. Okay. So this says here that, but they're going to have a principal outstanding amount because they're taking a loan of $81,000. They're taking a loan, $81,000. They take the loan. Interest will be how much? 6480. How did they calculate this figure? Okay, I'll show you what they did. 6480 came up because of this. I'll show you here. There, what is the rate here? 8%. Okay. And the 8%, 81,000, 8% of 81,000, that's the interest. How much is the lease payment? Sorry, the amortization payment? Payment is 20,286.97. So the payment will be 20,287 every year. Okay, they will make the payment. And this $20,286, in this amount, you have interest and also you have principal. Okay, so how much interest is there? 6480. So how much capital is paid? Principal amount is paid? $13,000 principal is paid. Okay, so when you pay off the interest already paid off, and also 13,806.97 is your principal amount. How did you calculate this figure? 20,000 minus interest. You got this? And this 13,000 will be subtracted now from 81,000, then you get this 67,000. Is it clear, guys? Everybody? Then again, this 67,193.03 will be multiplied with 8% again. Then you get the interest. And payment is again the same payment, 20,000. So 20,000 minus the interest, this much is your principal amount is paid. So you can see here, we can see here naturally, the interest is being paid. Interest is paid naturally in a smaller amount, but principal amount is paid in a bigger amount. Okay, so 50th time you pay off these things. This is your amortization table. You can see here, this is the case. You will have that every year you're going to make this. Now, cash outflow associated with the purchasing. What there are some other expenses involved in here. What other expenses involved? Maintenance cost, depreciation, interest. So these things are involved in. Okay. So maintenance cost, depreciation, and interest. All these things are your expenses. How much in there? 22,980. This money is your tax deductible. Okay. So you get tax benefit, tax shield of 689 federal tax. You multiply it by 30%. Okay, then you get this amount. After tax outflow is how much? 16,000 is your outflow. Okay, for next 5 years. All right. So this is the case. Okay. Look, this interest is actually calculated. This interest actually came, where it came from? Yeah. All right. The interest came from, yeah. And you can see this is the interest. So they are connected. Okay. All right. So here we say, for example, what we mentioned it here, how to calculate these things. So I showed you already. After tax outflow for the year, well, we mentioned this. All right. Now we're going to do the present value after tax outflow. So the present value of this figure, 16,000. All this 5, 1, 2, 3, 4, 5 years. The present value of all these figures will be calculated in here in the present value. But we're going to use the after tax interest rate. Okay. We're going to use after tax interest rate. Okay. All right, and then so how much we got here? We got here $72,000 will be the present value of all these cash outflows. So now, if we go for purchase, the present value of the money going out is $72,000 going out. But if we go for leasing, 74,000 will be going out. Which one are you gonna prefer? You're gonna prefer purchase. Okay. Another method is in here. Another method is in here. Are using a push to. I think this another way you can do the same thing you can do here. So the thing is that they will come to the same conclusion. They will become, yeah. Let's have a look at it. That's the only thing you'll have to learn about lease and purchase. Okay. So here we are doing cost of the car, lease rental, 20,000 we're doing for 5 years. Tax saving to the lease payments, like you saw that $6,000. So the first year we make the payment, but we gain the tax savings in the next year. And the purchase options at the end of 5 year, 13,500, which is the book value, $13,500. Okay, and this is the depreciations. So these things looks like I should. That would be nice. Okay, there are purchase options in there. So depreciation and tax sheet forgone is this much. Okay. And maintenance will be saved if you go for leasing. Okay. The maintenance tax sheet forgone, there you will lose the maintenance because we are not maintaining it. We're going for leasing. That time you'll be losing the tax benefit from the maintenance. So that's why it's a maintenance tax sheet forgone. The tax, like, because according to the leasing agreement, okay, but you cannot claim the depreciation. The lessor will be claiming the depreciation, so you cannot actually get benefit of depreciation. That will be also gone. All right, so that's what they showed you here. 13,500 is the depreciation per year, so 30% tax shield will be lost, okay. And you will be losing $4,050. All right, so after these things, incremental cash flow after tax is this. Incremental cash flows. So this is the money amount that money will be going. Okay. So now, now we're going to do the present analysis again. We'll do the present value analysis here. Present value after tax incremental cash flows. We're going to 62,000 present value after cash. That's okay. This indicates that for the same liability as incurred by the lease, the firm would have been able to borrow $62,000 from another lender, and we thus have net present value of leasing opposed to purchasing is 1,974. Okay. If we go for net present value of leasing, it will be negative. Okay. So since this is negative, the project is not acceptable by net present value criteria. So we have to go for purchase. So that's what I said. At the end of the day, you come to the same conclusion that you both have to go for purchase. All right, now let's move on to our next topic, which is introduction to options. So what is an option? Option is a contract, it's a financial contract. It's a type of derivatives in here, it's a financial contract. This says an option is a contract giving the buyer the right, okay, but not the obligation. It's a right, you're right, but it's not a legal obligation. Okay. Obligation to buy from or sell to the writer an asset at a specified price on or before the set specified date. So it is, let me explain a little bit more in a clear way, that it will be like this, that it will tell you that, it will be telling you that we are making an agreement, okay, that after 2 years, okay, after 2 years, I'm going to buy this asset. This asset here, we mean share, it could be a share. You can share a confidential asset too. So I'm telling you that I'm going to buy the share from you after 2 years at this price. Or I'm telling you that I will be selling this asset to you after 2 years at this price, or 2 years or 3 years at this price. Agreement we made. So this is an option, but this is not an obligation. I'm keeping this option open. I may not exercise it. I may not do that, but I'm keeping it open for my safety, for my security. That's what this option contract. They represent a claim against an underlying asset, normally a share. So that's what I mean. It is a share, and the outcome of dependent of the performance of the asset. The main difference from future is that an option is right, but not a required obligation. Because this is the thing. This is a right, it's not an obligation. Okay. So this is an example of derivative securities. All right. So there are two different types of them. They have one is call option, another one is put options. Two of them, two different things you have. One is called call option, another one is called put option. What is call options? So call options means that call. Okay, you're calling. Options which give the buyer the right to buy. You see, that's what they call. It means you're calling. It means you're buying. Put, you put in some other place. It means you're selling. Put options give the buyer the right to sell. Okay. So buy options, they say the call options which give the buyer the right to buy an asset from the writer at a specified exercise price on or before a specified. So they're telling, and this specific date, I'm gonna buy this asset from you, buy this share or asset from you at this price. They're making an agreement. Not necessarily they will buy. It may, maybe not they're not buying. It depends. Okay, but it's not an obligation. They will see how it goes. Okay, if they see the market price of the asset is, let's say, $20, and the agreement you made is $18. After in September 15, next week, September 15, I'm going to buy this share from you at $12 a share. On September 15, you found, oh my God, the share of this price, the price of the share is $20. Definitely you're gonna buy it because you already made the agreement to buy at $12. Give it to me, you buy it. But if you see the market price is 10, will you buy? No. Market price is 10. Why should I buy you at $12? Yes, I made the agreement, I pay for you that agreement, but I will not exercise that time. Because if I buy, I'm a loser at that time, I'm not gonna buy it. Okay, that's the case. Put it also the same way, selling. The market price is, let's say, $22 of an asset, but we made an agreement that I will sell you the share at, let's say, $27. You'll exercise it. But when you see the market price is actually, market is actually selling at a higher price than the agreed price, and you will not practice it. That's the whole point, the call option and put options. All right, an option is an instrument that provides its holder with an opportunity to purchase or sell a specific asset at a stated price on or before a specific date. Okay, the European and American options we have in here. Okay, it has nothing to do with country of origin of the options. European options can be exercised only on the expiry date of the option contract. American option can be exercised on or any other date prior to expiry. So that's the difference in here. European one can be done on a specific date. The American one will say before this date, like this. Okay. We will just consider only American style share options here. So two basic types of share options. The holder of a call option has the right. Okay, we will discuss these things. And here are some features. They are commonly for the purchase of sale of 1,000 shares. That's the features of this thing. What are the various features? So they are commonly for the purchase of or sale of 1,000 shares. The strike or exercise price is usually set at or near the market price of the underlying shares when the option is issued. The issuer of an option is usually called the writer. Who issues this option? They're known as writer. The purchase price of an option is commonly referred to as option premium. Listed options are standardized option related. So there are their features we have issued in here. Okay. The purchaser of an option is said to have the long position in the option. The seller of an option is said to have a short position in the option. So the profit from buying and selling various options illustrated diagrammatically. So you can see here that consider a call option. You're calling it buying. Okay. Buying purchase at a price of $1 with a strike price of $15. Okay. So it was purchased at a $1 price, $1 with a strike price of $15. So now when this strike price in here, let's look at this, that on this specific date, okay, when the price is 15, we're going to buy it at $1. The holder of this call option will not exercise the options unless the share price is over 15. I already mentioned these things. Okay, they are not going to buy it. Okay, the share price is over 15. Okay. Actually, I have to take these things. Increase these things. So you can see it better. Example: an investor buys a call option to purchase 200 shares. Stock price is 15. Current stock price is $10. So buying price of the call option is $1 per share. At the expiration of the option of the price of the share is $17. What is the gain or loss of the investors? Okay. The answer is this. Initial investment is price of the call option is how much? $1. Initial investment is $200. Since the price of the share is above the stock price at the time, okay, investor will gain. Okay, investor will gain. Okay. So expiration of the call option is the $70 will be there. So when the price is $17, he is going to strike at 15. The strike price is 15. Okay. So when they talk about $1, look at here. Price of the call option is $1 per share. Do not think this is the price of the share. No. When you make the agreement, when you make the call options, when you make the agreement, that agreement is saying, if you make the agreement for 100 share, okay, for every share you have to give $100 as a, let's say as a commission or something. Okay. So you spend $200 to make this agreement. That's how it is. Okay. So how much will be the gain? So he's buying at $15. The strike price is 15, but the current stock price is $10. So currently today, how much is stock price? $10. But I said I'm giving you $1 for 100 shares. What the agreement? The agreement is this. If today's share price is 10, okay? If the share price goes to 17, I will buy this share at $15. Okay. You see, so he's, look at here. So he's actually saying that $2 per share he's gonna gain. For how many shares? 100 shares. It will be 200. Okay. All right. And what will be the initial investment? $200 initial investment. So how many shares? They're dealing they're dealing for 200 shares. They're making the deal. Okay. So he's gonna make a gain of $400, but he has initial investment of $200, which is the expenses to make this deal. $200 will be his profit. Now here we go. So you can see the explain it to you. When the price is $15, I'm gonna make a strike. So $17, I'm gonna make a strike with 15. And another one is in here. Example is given here. Consider a put option to sell one share, purchased at a price of $2 with a strike price of 15. So $2 is your purchase options. Also put option that you bought for the $2. For how many shares? Did they say how many shares? Here is the example. So Mr. Martin buys a put option. Mr. Martin is buying a put option to sell 100 shares. The strike price is 70, so he'll be selling at $70. How much is current price? Current price is 65. Price of put option to sell one share is $7. At the time of expiration of the put option, the share price is 50. Okay, share price is 50. He's gonna sell it at 70. Okay. So he see the share price is dropping. When they see the share price is dropping, he'll go and make a call option. Oh, sorry, put option. So how much is initial investment? So for 100 share, $700 he will have to pay because he's making an agreement that for how many shares you want to do these things? He wants to do these things for 100 shares, for example. Okay. So initial investment $700. Under the terms and conditions of the put option, Mr. Martin can sell the shares for $70, realizing that the share price in the market, the price is 50. So he'll be making a gain of $20 per share. So net gain will be $20 into 100 share minus 700, 1,000. Hope this is not very tough. Okay. That's what they try to show it in here. Okay. That 200, 300, they're making it. The fundamental value of an option, considering a call or put option for one share, the intrinsic value of call option is the excess of the market price over the strike price if the excess is positive. How do they mean? They mean that excess price means that money you're actually making investments. Intrinsic value of the put option is excess of the strike price over the market price. If the excess is positive, otherwise you could say. How do they mean? Here it is. Interesting. Okay. So this says here, symbolically letting X and S be the strike and the market price. X is the strike price. Okay. So letting X and S be the strike and market price. So X is the strike price and S is the market price. Okay. That's what they mean here. That X minus X is your strike price. Okay. The market price is greater than the strike price into the value of call option to buy 1,000 shares. So call options mean you are buying. Okay. If you see that, very simple concept. When you're gonna buy, when you will see that that your market price is greater than the strike price. Okay. The strike price means what the agreed price, the strike price. Okay, then you're gonna buy it. All right, and the put option selling it, when you see that the strike price is lower than the market price, you sell it. It's simple. Okay, so here is the example they say. What is the intrinsic value of a call option to buy 1,000 shares Strike price of 15 if the market price is 18, market price is 10. Okay, so this is intrinsic value max into x minus s. Okay, call options. S minus x. S is your market price, x is your strike price. Okay, market price is 18, strike price is 15 into 100, so 3 into 1,000. Sorry, 1,000 shares, 1 to $3,000. Okay, so here you look at here in this case that your market price is 10, strike price is 15. You know what? Why this is 0? Because there will be no transaction. They will not do it. That's why this will be 0. Because they're not going to do this practice distance. That's the case. All right. Let's move on to our 6:30 here. Let's move on to our what other questions from last week. Do you guys have any question to ask me, guys? Any questions for me, please? No? Thank you very much, Tuan. I know your mic is not working today. Thanks for letting me know. All right, let's do this problem set today. All right, the first question here we have is that why do we use market interest rate instead of historical interest rate in calculating a firm's cost of debt? Why do we do this? That's a good question we have. So the question is, why do we use market interest rate instead of historical interest rate in calculating the firm's cost of debt? Why do we prefer to use market value instead of book values? Okay. All right. So we're interested in estimating what would be the cost of firm issuing additional debt. So the answer is this, that the return required by prospective investors in the firm's new debt will be given by the market rate of interest. How do we mean by this? The return required by the prospective investors in the firm's new debt will be given by the market rate of interest. So the person who is making the invest, so look, when you are going to buy a share, you are giving money to the business. Of course, if this money is not coming from you, they had to get this money from the bank. They had to pay interest rate. So when they take the money from you as a shareholder, you'll be expecting, okay, if they take the money from the bank, how much interest they would pay to the bank? Let's say 3%, 4%. So of course, I'm giving you the money, so I should expect at least that much money. One way. Another way of thinking is this. Well, if I keep the money into the bank, they would give me 2% interest. If I'm giving you the money to your business by buying a share, you should give me 2% at least. This is the current interest rate is important here. So that's why we use the market interest rate. Okay, that's the answer. All right. Then why do we assume business and financial risk are unchanged when evaluating cost of capital? Why do we assume business and financial risk are unchanged? Okay. All right. So the says here is that holding the business risk constant assumes that the acceptance of a given project leaves the firm's ability to meet operating expenses unchanged. The question is this, look, business risk, what is business risk? Understand that. Business risk means that business is unable to generate its operating cost. Okay. From where they take the loan, how they take the loan doesn't matter. How much is cost of capital doesn't matter. The point is business cannot generate its operating cost. That's the point. Okay. So this remains always unchanged. Okay. It has nothing to do. Okay. What is financial risk? Financial risk is that business is unable to pay its finance cost. Finance cost involves what the finance cost involve? Interest payment, lease payment, other like accounts payable payment, this type of financial expenses related there. These are not net. They're unable to raise that money. Okay. So now the question comes up, at what rate you take the money, that's not the point. The point is the business. Now you're going to actually take a loan from a bank. And if you cannot raise, the business is not efficient enough to raise the operating cost. Doesn't matter what person they're giving you the loan from. Not really. Okay. Yes. So these are the risk remain unchanged. Risk always be there. The business this has nothing to do with at what rate you're taking the money from bank. This is that they cannot sell much. If they take a lower rate of interest, will their sales increase? Not really. Okay. What is meant by the net proceeds from the sale of a bond? Net proceeds means that when you sell a bond, this bond might have some other finance costs. Issuance cost, this cost, those costs, different type of costs. After subtracting all the expenses, what is left, that is called net proceeds. Okay. The next one, what is flotation cost? Flotation cost are the total cost associated with the issuing and selling a security. What are the main cost involved there? It's not about net proceeds. Net proceeds will be how much money you raised minus how much is the finance cost, other costs involved. Those other costs are your floating cost. Okay. Number 4. In January 2013, the CFM Corporation considered a project A requiring an initial investment of $200,000. Okay. All right. So what this says here is that in January 2013, CFM Corporation considered a project requiring an initial investment of $200,000 and subsequently yielding annual after-tax living incremental cash flows of $30,000 for 10 years. At the time, the firm's after-tax cost of new debt was 8% per annum. Its cost for new equity was 13% per annum, and the firm could only borrow a maximum of $200,000. A year later, in January 2014, CFM had the opportunity of investment in another independent project, Project B, which required an initial investment of $200,000 and was expected to yield annual after-tax incremental cash flows of $36,000 for 10 years. Okay. So there are two options, Project A and Project B. The same. Okay. The Project A requires $200,000. And how much it will be generating? $30,000 for next 10 years. And at the time, after-tax cost of debt will be 8%. And its new equity was 13% per annum. And they have another options they have in here that which requires $200,000 expected in yield annual after-tax yield is $36,000 for next 10 years. If the firm had simply used the cost of the lowest cost from financing to calculate the net present value of the project in January 2013, what would have been called? What would have been this calculated as net present value? Okay. So net present value here, net present value for A will be equal to $30,000 multiplied by 30,000 multiplied by 1 minus 8 is okay. Minus answer will be equal to 1,000. That will be the answer. All right. This is 30,000 for next 10 years, 8% interest rate. This is their incoming. Outgoing is to be $200,000. Incoming, the present value of incoming minus outgoing is actually on the present time. Suppose that based on the results for part A above, CFL Corporation undertook a project A in January 2013 using only debt financing to raise the capital to cover the initial investment. As this exhausted the firm's debt raising capabilities, it evaluated the net present value of project B a year later using its cost of equity for which simplicity will assume 30% per annum. Under this assumption, and supposing the firm based its investment decision purely on the net present value criteria, would the firm have invested in project B? Show the result. So what they're trying to say here is very simple, that we have to calculate 30% interest rate for project B. Okay, let's see. We're gonna do exactly the same thing in here, but this is for project B. So this is not 30 anymore. $36,000. Not 8%, it will be 13%. But both of them has the same thing, 10 years and 200,000. Then here the answer comes as minus those. So since the result is coming as minus, there will be a positive. But if the firm had instead used the weighted average cost of capital, we are saying that if the firm has gone for weighted average cost of capital, how much? Okay. Capital on target weights of 50% debt, 50% equity in calculations. What decisions would it have taken in respect to investment project A and B? Show calculation supportive answers. Okay. All right, so let's calculate our WACC. Cost of capital will be equal to since this is 50-50, 0.8 will be the average. Okay, plus if it was not 52, we would have to multiply it by that weights here is same 50, so we are going for average. Okay. Okay. Now we have to calculate now with this 0.105, with this 3, we have to calculate this number. Okay, 30,000 is fine. This is not 0.08 anymore. This will be 10.5. So 0.5. This will be here. 0.5. Okay. Condition. Here the answer will be coming as minus 19,556.82, and this one will be coming in here. Minus 16,000. That can be double productive. Okay. All right. D. C. All right, so in D, the question is, what conclusion can you draw regarding the desirability of basing individual current capital value decisions and the cost of the currently lowest cost source of financing? Okay. Look, source of financing, like how much they're gonna pay, it will be depending on, like it's one criteria. There are some other criteria involved in here as well. So this is actually criteria, but it depends on the long running relationship of financing institutions. Okay. The bottom line is the overall value of the firm is related to its overall weighted average cost of capital. That's the bottom line. Okay. Number 5. Says here, after a careful analysis, Dexter Brothers Limited has determined that its optimal capital structure, okay, optimal capital structure is composed of the following sources and target market value rates. Okay. This is source of capital, 30%, share capital 15%, ordinary share capital 50%. So they say they are going to raise their money from these ways. Ordinary share will be 55%, but preference share will be 15%, 30% will be the long-term debt. Okay. Now, the cost of debt is estimated at 7.2%. The cost of preference share capital is estimated to be 13.5%. The cost of retained earnings is estimated to be 16%. And the cost of new ordinary share equity is estimated to be 16%. All these are after tax rates. Currently, the company's debt represents 25%. The preference share capital represents 10%, and the ordinary share capital is 55%. The total capital based on the market values of 2 components. So 3 ways they want to go for division, the desiring distance. The company expects to have significant amount of retained earnings available and does not expect to sell any new ordinary share equity. Calculate the WACC based on the history market value weights. Calculate the WACC based on target market value weights and compare the answers obtained by the MD explain the difference. All right. Now we have to do these things in historical market value rates. Okay. Great. Yes. Okay, here we go for long-term preference ordinary. The last one is all right. How much is my weight for long-term debt? 25, 10, and 65. Okay. 25, 10, and 65. That's what it's currently. And cost, 7.2, 13.5, and 16. This is the mistake. Purchase cost, multiply this. Percent. What is the weighted average cost will be? Add them all up. Calculate the work based on the target market rates now. Target one is mentioned before, the target is in here. And 30, 15, 55. The costs remain the same, so it will be changing here. Two, six. Eight. Weighted average 12.9. That's okay. So work here you can see is lower than the previous one. Previous work was at 13.55. If you go for target one, it will be 12.985. Less. Okay. Number 6. Dr. Field Media Corporations faces an effective company income tax of 30%. The firm is financed with debt, preference capital, and ordinary equity, for which the following details are available. So debt, preference capital, ordinary share, ordinary capital, three things we have described here. And that the firm has 5,000 corporate bonds on issue, each with a face value of 1,000 and a maturity date is 5 years time. The bond paid interest annually with a coupon rate of 7.5% per annum, and the current yield to maturity is 8% per annum. All right. 100,000, and here is that preferential 100,000 preferential on issue at $10 per share per value. The annual preference is 8% per value, the current potential $8. Ordinary is 400,000 ordinary shares are on. Do that. And the current ordinary share price $6 per share. The equity beta for those ordinary shares 1.1. The expected return on the market portfolio is 7% per annum, and the risk-free rate of interest is generally 4% per annum. Given the above information, and assuming the capital asset pricing model is valid, CAPM is valid, calculate the current weighted average cost of capital for the preferred media operation. Rounding figure to notes over 2 decimal points. We have to calculate the current weighted average cost of capital for the preferred. All right. Let's do it. For debt, we say that RD is equal to 0.08. Next is market value of each bond. Yes. Yes. True. So the total market value for the debt will be how much? Total operating debt. All right, so marketable for debt equal to 5,000 returns. 5,000. Right. Two. This is the debt section. Okay. Now we'll do for the differential. The differential. All right, marketability for differential. At the moment is 800,000. The current market value is now 800,000. Okay. We're going to apply the perpetuity formula in here. We'll say that price will be equal to dividend divided by rate. Price equal to dividend divided by rate of differential. So you can solve from here, okay? You know the price. You can say dividend divided by, you can say this way. Okay. Now you can say how much is my dividend here? Dividend will be 0.8 by 0 multiplied by 10. Right. This is the price. And And now we're going to do with the ordinary shares. That's going to be the ordinary shares. Dot reference ordinary shares. All right. So RS equal to reward plus beta 2 okay. So electricity is equal to 0.04 plus okay. So that's what is our. So we got actually three things we got. So for differential, we got 0.10, ordinary we got 0.073, and for the data show, we got these things. Total value of the form. Total value of the form. Now, total value of the form will be equal to 4,000,000 50 plus 2. Now, how much will be our work? Right. So I want to keep this all in. So distance plus it's very driven in the same here. 800,000 now. So look at here, what we did is very, very simple. We try to do what total value of the fund. So in debt sector, how much? In preference share, how much? And in ordinary share, how much? For the total. So we got the, so we divide this, divide by this, divide by this, divide, we get the proportion with that. That's what we did. And we multiplied the proportion with our interest rate. For ordinary share interest rate is 0.73 multiplied by 0.73. And for preference share, it's 0.10 multiplied by 0.10. And for debt, this is 8%, but we took the tax benefit in here. That's why we subtracted 0.3. That's it. Okay. The answer will be equal to the answer is 0.06. Okay. Which will be equivalent to, which will be equivalent to 6. Okay. That's it. That will be the answer. Okay. That's it for today. Any question for me, guys?
No, I think that was pretty clear.
Thank you very much. All right. I would like to stop recording.